Are you looking to boost your investment income with dividends? What if I told you there's an ETF that not only offers a solid yield, but is also backed by some of the most reliable companies in America? Today, we are diving deep into the SCHD US Dividend Liquidity ETF known as SCHD, one of the most popular dividend ETFs in the market currently. SCHD, or the SCHD US Dividend Liquidity ETF, focuses on high-yielding, financially stable stocks. Its appeal to investors is primarily due to its competitive dividend yield, low expense ratio, and emphasis on quality, making it one of the most favored choices for those seeking stable income and growth potential, which any investor would want or dream about. To get things started, we need to understand what SCHD is and what it does. SCHD is designed to track the performance of the Dow Jones US Dividend 100 Index, giving investors exposure to a curated selection of dividend-paying stocks. What sets SCHD apart from most is its focus on not just high dividend yields, but also stability and quality. It aims to strike a balance between income generation and risk management. Let's delve into some key features that make SCHD tick. With a promising dividend yield of 3.48%, SCHD is one of the most competitive options in the high-yielding index funds market. We'll discuss how this yield stacks up against other alternatives. SCHD has an outstanding expense ratio of just 0.06%, meaning you're investing more in the long term, as high expense ratios can often affect your portfolio and its long-term performance. SCHD's low expense ratio offers a significant advantage. With a fund so big, SCHD has high liquidity that contributes to allowing its investors to execute trades efficiently. This high liquidity allows lower transaction costs and tighter bid-ask spreads, ultimately benefiting investors. Diversification is key to managing risk, and SCHD achieves this by holding a basket of low-risk, high-dividend-paying stocks. We'll explore the number of holdings to understand the fund's breadth. With today's uncertain market environment, it's hard to find golden players who can consistently pay you and grow your portfolio. SCHD achieves this by consistently paying out dividends and achieving strong growth.
Danger at every turn. That's why we at Stratton Oakmont pride ourselves on being the best.
With substantial funding and a clear strategic focus, SCHD primarily allocates 17.12% in industrials, 16.73% in financials, and 15.90% in healthcare. These key sectors significantly contribute to the ETF's robust dividend yield and overall growth potential. SCHD portfolio includes pivotal companies such as Lockheed Martin, Texas Instruments, Chevron, Pepsi, Cisco Systems, Verizon, UPS, Coca-Cola, Amgen, and Pfizer. Each company not only brings a strong dividend history and financial stability, but also significantly impacts the ETF's performance with their specific weightings. For example, Lockheed Martin might constitute 4.23% of the ETF, while Texas Instruments might constitute 4.14%, and so forth. This granular detail highlights the diversified yet strategic investment approach of SCHD across various sectors. SCHD undergoes an annual reconstitution to rebalance its portfolio, either adding or removing holdings based on the performance and suitability. This year's reconstitution saw minimum rebalancing. Notably, Pfizer and PepsiCo have risen into top holding positions, while Bristol-Myers Squibb also secured a prominent spot. Conversely, Broadcom and Merck were removed from the top holdings. This decision reflects a strategic move to capitalize on their substantial gains, illustrating a disciplined approach to investment that removes emotion from selling high performers.
That's my quant.
Your what?
My quantitative. My math specialist. Look at him. You notice anything different about him?
With such a long history, let's take a closer look at how SCHD has performed in comparison to the broader market, represented by the S&P 500, or America's top 500 companies. Understanding these comparisons can help investors gauge SCHD's effectiveness as a dividend-focused investment vehicle relative to general market trends. In 2023, SCHD posted a return of 4.57%. With dividends reinvested, the total return was 4.7%. In contrast, VU, which tracks the S&P 500, delivered a significantly higher return, outperforming SCHD by more than 22% with dividends reinvested. It's important to note that while SCHD did not match VU's performance this year, the two funds have different objectives and compositions, which can lead to differing short-term results. Looking at the last 3 years, SCHD has delivered a total return of 33.2% with dividends reinvested. In comparison, VU outperformed SCHD by a narrow margin of 1.8%. This close performance underscores SCHD's strength as a dividend-focused ETF, proving its capability to compete closely with broad market indices over a long period. Over the past 5 years, SCHD has seen an impressive total return of 92.3% with dividends reinvested. Although VU outperformed SCHD by 14.5%, SCHD performance highlights its robust dividend contribution and growth potential. Historically, SCHD has exhibited a trend of increasing dividend payments, mirroring the growing profitability and cash flow stability of its constituent companies. Notably, it boasts a promising 5-year dividend growth rate of 11.80%, enabling investors to potentially outpace inflation and increase their overall payouts. A primary appeal of SCHD is its focus on firms with a strong history of dividend payouts, crucial for investors seeking reliable income streams. SCHD consistently distributes dividends quarterly, reflecting its strategy to invest in companies that have not only sustained but also have grown their dividends over significant periods. The resilience of SCHD's dividends during varying market conditions is also noteworthy. During downturns or volatility, SCHD's emphasis on financially stable companies helps maintain its dividend payouts, contrasting with sectors more prone to cutting dividends during economic hardships. Every investment carries certain risk, and it's crucial to understand these before making any significant investment decisions. SCHD has substantial allocations in specific sectors such as industrials and financials. While this focus can be advantageous during times when these sectors perform well, it also exposes investors to increased risk during downturns. This sector concentration can result in higher volatility compared to more diversified funds. Like all liquidity investments, SCHD is susceptible to market volatility. Its performance can be significantly impacted by general market movements, which may be influenced by economic cycles, geopolitical events, and shifts in market sentiment. Such volatility can lead to considerably short-term performance fluctuations. Some sectors within SCHD, especially financials, are sensitive to changes in interest rates. Increases in interest rates can adversely affect these sectors, thus impacting SCHD's overall performance. While SCHD invests in companies known for their robust dividend histories, dividends are never guaranteed. Economic downturns or specific issues within these companies can lead to reduced or suspended dividend payments, affecting the expected income from SCHD. The annual reconstitution process of SCHD, which involves reviewing and adjusting its holdings, may cause periods of underperformance. This could occur if newly added stocks fail to perform as expected or if beneficial stocks are removed based on the fund's screening criteria. Understanding these risks is vital for any investor considering SCHD. Although the ETF offers significant benefits, particularly for those focused on dividends, being aware of these potential drawbacks is essential for making informed and balanced investment decisions.
Nothing. Y'all believe what y'all want to believe. That's a half a ticket right there.
SCHD competes closely with other major dividend-paying ETFs like VYM and HDV. Let's see how they compare in terms of dividend yield, expense ratio, performance, sector allocation, and fund size. SCHD is known for its attractive dividend yield of 3.48%, which is slightly higher than VYM's 2.97% and equivalent to HDV's yield of 3.48%, positioning it as direct competition to HDV. Expense ratios are crucial as they directly impact net returns. SCHD offers an expense ratio of 0.06%, which is slightly higher than VYM's 0.05%, making VYM marginally cheaper. HDV, however, has a higher expense ratio at 0.08%. Looking at the overall performance of these ETFs, over just 1 year, VYM leads with a return of 6.8%, with SCHD following at second place, surpassing HDV by 2.4% overall. Over 3 years, VYM continues to lead with a total return of 35.6%, slightly ahead of SCHD by 2.4%. HDV lags with a return of 31%. At the 5-year mark, SCHD excels with an impressive return of 92.3%, significantly outpacing VYM by 24.5%. HDV trails considerably with only a 46.4% return. The ETFs differ in their sector focus. SCHD is heavily allocated towards industrials, VYM towards financials, and HDV predominantly invests in energy. These sector preferences influence the performance across different market conditions. When we look at the fund size and the liquidity of these ETFs, we find that SCHD manages $53.65 billion in assets, while VYM is larger at $67.87 billion. HDV managed about $26 billion, making it one of the smallest of the three. Concluding this comparison, each ETF, SCHD, VYM, and HDV offers unique advantages based on an investor's goals, risk tolerance, and market outlook. Let's quickly recap the key insights we've covered about the SCHD US Dividend Liquidity ETF, SCHD. We discussed SCHD's aim to track the Dow Jones US Dividend 100 Index, focusing on high dividend yielding stocks that are financially healthy. We examined SCHD's performance over the past 1, 3, and 5 years, comparing it with major indices and showing its capacity for growth and income generation. We highlighted SCHD's main sector allocations and its top holdings, showcasing the diversity and strength of its portfolio. We explored how SCHD has consistently delivered strong dividend growth, making it appealing for income-focused investors. We outlined potential risks such as sector concentration and market volatility, which are important for informed investment decisions. Finally, we compared SCHD to other dividend ETFs like VYM and HDV, discussing their yields, performance, and expense ratios. If you found this analysis helpful and want to stay updated with more insights, don't forget to like, subscribe, and hit the notification bell, guys. Share your thoughts or any questions you have about SCHD in the comments below. I'm here to answer any questions you guys have, but please remember that this video is for informational purposes only and is not financial advice. Always do your own research, and if you have to, consult a financial advisor. But thank you guys for watching. I appreciate the support lately. We reached 10 subscribers, so thank you guys so much. I'll see you guys in the next video. Thank you guys so much. I appreciate it. Hopefully you guys enjoyed this video, by the way. I put a lot of work into this. So, anyways, I'll stop talking now.
This shit means something to me, man.